The electric vehicle in your driveway and the smartphone in your pocket rely on a supply chain that begins long before a factory assembly line. It starts in the dirt, requiring a massive, heavy industry to refine raw earth into the metal that powers modern life. Alcoa Corporation is one of the primary architects of this process. Their first quarter 2026 earnings report provides a data-driven look at how global industrial giants navigate simultaneous logistical and environmental disruptions. This graph tracks a significant decline in Alcoa's top-line revenue. The company reported a 7% sequential drop to $3.19 billion, missing Wall Street's consensus expectation of $3.3 billion. This decline followed a series of physical disruptions. Geographic shipping bottlenecks in the Middle East delayed core shipments, while Cyclone Norell in Western Australia forced a slowdown of operations at the very start of the supply chain. While revenue declined, Alcoa's operational profitability moved in the opposite direction. Adjusted EBITDA grew 12.9% sequentially to $595 million, indicating that the company's internal margins improved even as its total sales volume took a hit. Managing a multi-stage industrial pipeline, from raw ore to finished metal, allows a producer to isolate specific costs. By controlling each phase, a company can adjust its operations to absorb regional shocks that would otherwise halt production entirely. The first stage of this pipeline is the extraction of bauxite, a red, clay-like ore mined from massive open pits in Australia and Brazil. In the first quarter of 2026, Cyclone Norell physically flooded these mines in Western Australia. This weather event forced Alcoa to defer core shipments, creating an immediate bottleneck at the source of the metal's life cycle. After mining, the bauxite undergoes a chemical refinement process to extract a white powder called alumina. This powder is the intermediate ingredient required for all aluminum production. The alumina segment saw a 33% sequential revenue decline this quarter. While refineries remained active, shipping bottlenecks in the Middle East meant the powder remained stuck on cargo ships rather than reaching international buyers. With both mining and refining hampered by geography and conflict, the quarter's financial performance depended on the final, energy-intensive phase of the metal's journey. The final stage is smelting. To transform alumina powder into liquid aluminum, Alcoa uses a process that consumes massive amounts of electricity, leading the company to locate its smelters near cheap, renewable energy sources like hydroelectric dams. Smelters use high-voltage currents to melt the alumina powder into pure liquid aluminum, which is then cast into ingots or bars. The aluminum segment remained resilient because of higher average market prices and strict expense discipline. These factors allowed the final stage of the pipeline to generate higher margins, helping to offset the logistical losses occurring upstream. Alcoa also utilized a $100 million short-term borrowing strategy to move its existing inventory. By spending cash to reposition metal within North America, they ensured product was available in high-demand markets, despite global shipping delays. Beyond raw metal, the company is shifting toward high-end customized products. Manufacturers like the fictional Volt wheels increasingly seek low-carbon aluminum for vehicle frames, creating a market where Alcoa can charge a premium for green metal. To meet this demand, Alcoa invested $65 million into its Mosjøen smelter in Norway. This capital allows the facility to integrate recycled scrap directly into the casting process, lowering the overall carbon footprint of the finished product. By pairing renewable hydropower with recycled content, Alcoa targets the green premium market. This strategy allows the company to differentiate its products from standard global commodities. To prepare for future volatility, Alcoa is optimizing its balance sheet. The company is using cash on hand to redeem $219 million of its outstanding senior notes due in 2028, reducing its long-term debt obligations. Operational stability also improved with the ratification of a new labor agreement with the United Steelworkers. This contract secures the workforce for approximately 965 employees across Alcoa's U.S. smelting portfolio. Additionally, the progressive restart of the San Ciprián smelter in Spain is underway. This move is designed to increase production capacity and recover volume lost during the upstream disruptions in Australia. This waterfall chart illustrates the outlook for the second quarter of 2026. As delayed shipments finally reach customers, Alcoa expects a $55 million favorable sequential impact on its adjusted EBITDA. However, external costs remain a variable. Rising metal prices are expected to increase Section 232 tariff costs on Canadian imports by $35 million, creating a direct headwind against those projected shipment gains. Alcoa's performance demonstrates that vertical integration, controlling the path from ore to ingot, provides a structural buffer. By managing the entire pipeline and investing in low-carbon infrastructure, the company can maintain operational profitability even when the global logistics network faces significant friction. This video is for educational and informational purposes only and does not constitute financial advice. Always do your own due diligence.